Hi, welcome to Savant's quarterly market review for the second quarter. My name is Gina Beal, and I'm a member of Savant's investment committee and research team. The first slide here is a quick overview of world market returns. Global markets across the board posted positive performance for the quarter. Among stocks, global REITs and emerging markets gained the most in the quarter, followed by U.S. and developed international stock performance. Lower yields on bonds resulted in solid gains across global bond markets. Next, we'll show you a brief overview of the quarter's events. In April, we saw employment in the private sector hit a new high, and housing data got off to a slow start. Then in mid-quarter, Ukraine got a lifeline from abroad, and by mid-month, bonds and emerging markets rallied. Then, during June, the Fed signaled that interest rates would stay low for a long time. New home sales jumped to a six-year high, and the first quarter reading of U.S. GDP was revised to a sharp negative 2.9%. Markets and economists shrugged that data point off, citing temporary reasons such as a rough winter season. And the quarter ended with a return for the S&P that was the strongest since the second quarter of 2009. The next few slides will be focused on the different asset class returns. As I just mentioned, the U.S. equity market recorded positive performance. Large cap stocks outperformed small cap stocks, and within small caps, value outperformed growth. Within large caps, value and growth recorded similar performance. The bull market we've experienced the past 5 years continues to be supported by rising corporate profits in an environment with low inflation and low debt obligations and higher productivity for companies. For developed international stocks, performance was in the same ballpark as that of the U.S. Similarly, large cap stocks outperformed smaller cap stocks. The U.S. dollar depreciated relative to many of the major international developed currencies during the quarter. Canada was a top performer with over a 10% return, while Italy and Ireland recorded some of the lowest returns. Moving to the lesser developed countries, despite geopolitical tensions in Iraq and Syria, there was a reversal in performance for emerging markets from the previous quarter, and they surged 6.6%, outpacing developed markets. Similar to developed markets, large caps outperformed small caps. Turkey and India led performance in the emerging markets. But the strongest performers were the even lesser developed countries known as the frontier markets, which posted a 11.9% gain. Global REITs continued their strong performance and outperformed all other major asset classes, up 8.3%. Commodities, on the other hand, had a rocky quarter, ending just barely in the positive, up 0.1%. Lastly, we take a look at bonds. The U.S. Treasury yield curve flattened slightly during the quarter as intermediate and long rates fell, while short rates were unchanged. The lower yields brought positive bond market returns. Many pundits expected rates to drift upward as the Fed continued its plan of reducing stimulus and buying fewer bonds. However, demand for bonds has remained high among institutional investors, and the supply of Treasury bonds has actually decreased this year as the U.S. needed to issue fewer bonds due to reduced spending. Inflation-protected bonds, also known as TIPS, led fixed income returns. Intermediate term and foreign bonds also posted gains in the quarter. Putting the asset class returns together, the portfolios on this slide illustrate the hypothetical performance of different global stock and bond mixes made up of indexes. The return differential across different allocations was quite wide this quarter. You can see that the hypothetical investor with 100% stocks would have earned about a 6.5% return, while a portfolio of 100% bonds rose a smaller amount of 0.9%. So to sum up, the second quarter offered us plenty of surprises. The first quarter U.S. GDP was revised to a decline of 2.9%. Bond yields moved lower instead of higher. Uncertainty in Iraq caused a spike in the price of oil. But perhaps the best surprise was that every major asset class delivered strong returns. So while there will be inevitable market pullbacks over time, globally diversified portfolios are constructed to weather the many events and surprises that come our way. That concludes our second quarter update. Thanks for listening today, and please join us next quarter.